It's 5 o'clock in London, 6 p.m. here in Warsaw, in Poland, where I am today. Midday in New York, midnight in Hong Kong, 3 a.m. in Sydney, 9 a.m. in San Francisco, 9:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO-VID live stream, Series 32, Episode 3. That is in the aggregate. Episode number 189 starts here. Down under, ASX, the architects of failure as a service, maintain a stubborn belief that the world might be flawed, but they are all perfect. I think the appropriate word at the moment is delulu for the Australian Stock Exchange. Meanwhile, the Kraken have acquired the CFTC-regulated small exchange for $100 million. The seller, IG Index, makes a handy profit selling the small exchange to Kraken, with both buyer and seller pursuing crypto ambitions in opposite directions. Terrific news from Connemara only weeks before their AFM Tech Day in Chicago. Look out for more coverage about that. Join me if you can, if you're in Chicago on that day, because I'm going to be interviewing the fabulous, the incredible, the OG of financial derivatives, Professor Dr. Richard Sander himself, talking about his wonderful life in markets. Anyway, terrific news from Chicago only weeks before that AFM Tech Day in Chicago. They've been licensing, once again, their tech stack is now going to be going to Electron X, the first US regulated direct access electricity derivatives market. Meanwhile, all the best to Meg from HPR. That's a new ultra-low latency, fully hardware-based matching engine gateway. And last, but by no means least, Germany is open to handing more power to EU markets watchdogs, and indeed Germany's Prime Minister, the Chancellor Friedrich Merz, is actually wanting to have a mono market, a sole European stock market. The insanity of it all, ladies and gentlemen. Mono market madness emerges in Brussels with a daft cut and shut plan to crucify European Union capital markets as the failure to deliver. CMU is now clearly pushing towards ESMA central planning. Our guest today, ladies and gentlemen, is Jose Andres Mayora. The topic is Wall Street's blind spots. Jose is the author of the self-same eponymous book, Wall Street's Blind Spots, and co-founder of the DeVita Value Growth Fund, a long-term public equities fund grounded in value investing principles. Jose Andres serves as its senior portfolio manager, overseeing global equity investments and fund operations. Jose, welcome to the show. Where in the world are you today?
Thank you, Patrick. It's great to be here. I'm in Guatemala.
Wow, that was my second guess, obviously. So whereabouts are you in Guatemala, as you're the first guest we've ever had in 189 shows to appear in that fine South American nation?
Well, I'm in my offices in Guatemala City, which is, the capital of Guatemala, and I'm glad to be the first person to be invited from our country.
That's absolutely fantastic. So tell me a little bit about this. I mean, how did you manage to start your journey into investing on Wall Street and all around the world? And indeed, how did it all begin? So you were born in Guatemala City?
Yes, that's correct. I was born and raised here in Guatemala City. And basically, after high school, I kind of just went deep into economics and finance. I studied double major finance economics, then I did the CFA, I worked in investment banking, but all throughout those years, I always wanted to be a value investor. I kind of did my own type study of value investing. It really clicked with my personality. I also think it's the best way to invest for 99% of us. And so I always knew I kind of wanted to do a fund here in Guatemala, but I wasn't sure I was going to be able to do so because the culture here in Central America for investing in public market is not that wide, and so I didn't know if it was going to be possible. But thankfully, I found the right partner and the right setup, and here I am, and I'm super happy with what we've been able to achieve, and trying to help people get access to public markets in a smart way. So I'm pretty happy.
That's incredible. What a fascinating story altogether. So tell us then, Jose. I mean, you got into working for an investment bank. You've worked all your career in Guatemala, or have you also worked elsewhere?
No, I actually been all throughout the world. I started in the US, then stayed in Philadelphia, worked there for almost 5 years in investment banking. Then I went to do a master's in economics in Europe, and then I worked there for a little while, and then eventually came back home. So I think I worked almost 12 years outside, and then I came back home for family and personal reasons. So part of my time has been abroad.
Fascinating altogether. So tell us a little bit then about, your fund. What do you actually invest in terms of what markets, what geographies, and what kind of shares?
Yeah, so we're actually agnostic in terms of where we invest, and there's a perfectly good reason for that. We're value investors, which just basically means we try to find undervalued opportunities, and when we find them, we like to take concentrated positions in them. And if we were to select just a geography, call it the United States, for example, and say, okay, this is where we're going to invest, what happens if there aren't any undervalued opportunities in the US? Well, we wouldn't be able to play our game, right? So we are all over the world. We have investments in China, we have investments in Europe, we have investments in the US, we have in South Korea, we had at some point in Israel. So we're pretty much all over the world.
That's fascinating altogether. And so tell me, in terms of, we'll get on to value investing and talking about that in just a moment, but in terms of sourcing information and finding out about all of these companies, obviously it doesn't sound entirely natural to come out of Central America and be looking to invest in not just China, but Korea et al.
Yeah, no, and that's the beauty of public markets, I think, that you don't have to be where you invest. And the way we kind of do the sourcing, or the way we try to approach it, is to kind of do what they call AST investing, where we just grab an index somewhere in the world or some for some industry, and we go and look at every company A to Z, and we start using the framework I have from the book. I know we're going to discuss, but we use that framework to quickly filter out which companies are compounding and which companies aren't. And since we're long-term holders, that's very important for us. And so we're able to do this pretty much from Guatemala or anywhere in the world, or on vacation, wherever we are, because it's publicly available information. So that's how we typically do our sourcing in a very independent and unbiased way. We don't try to go and look at different analyst articles and things of that nature just because we want to remain unbiased all the time. But we first do our analysis, we first do our filtering, and after that, that's when we start second guessing ourselves with other people's opinion.
Fascinating altogether. So tell me a little bit then, what was the genesis of what led you to writing your book, Wall Street's Blind Spots?
Yeah, well, there's a lot of reasons for that, and definitely passion comes along with that. But I think the most important reason is because for a very, very long time, I realized that most people really miss the most important things about investing and about valuation in particular. And I include here not just retail investors, but also sophisticated investors. I firmly believe that the way people go about valuation to try to determine whether something's worth it or undervalued or whatever it is, they go about it the wrong way. And it's not because I'm smarter than everybody else. It's just because the way finance and the study of finance has evolved is that people try to be very precise. And in the pursuit of precision, they essentially go and do complicated models, and they introduce terms like WACC and beta and all these things. And in that pursuit, they kind of miss the most important things. And so I wanted to shed light to what those missed things are and why they're so important.
Fascinating altogether. So obviously, you adopt a value investing approach and you help people understand how that works. Walk us through a little bit, what is the core thesis of the book?
Yeah, absolutely. So the core thesis of the book, it's kind of maybe split into two. One is just a very brief part of the book, which is trying to explain why value investing can be so powerful. And essentially, value investing can be so powerful because it kind of breaks the risk-reward paradigm. When you buy an undervalued company, one that's truly undervalued, and you really invest with a wide margin of safety, the probability of loss is very, very low. And at the same time, the probability of a very nice return is very, very high. And so I kind of start with that part, but then the natural question becomes, okay, but how do you value a business? If it's so powerful to find and invest in undervalued companies, how do you go about and do that? And so the second part of the book tackles that, but it tackles it in a way that's completely different to the conventional approach. So typically the way it works is people try to project the future, the company's cash flows, etc., and then bring that to the present by discounting them, or maybe they do some comparables analysis comparing price to earnings ratios for other companies and things of that nature. But what I argue is that that's the wrong way to go about it. What you really need to do is you start with a valuation today, and with public markets, it's easy because it's you can see the market value of the valuation today. But even in private markets, you can just use a hypothetical valuation and say, okay, what really needs to happen for you to get your desired return? And so it kind of flips the script in that way. And when you do so, you start realizing that there are some important things that the traditional valuation methods miss. And the most important one of those, if I have to sum it up, is that capital allocation is absolutely key. So what that means is essentially that it's not just about what the cash flows of the company are going to be with the existing kind of company framework. It's about how those cash flows in the future are going to be reinvested and whether they're going to be reinvested adequately. Because it happens a lot where like a company, it's a good company, but then they decide to do a huge acquisition, for example. So they grab all of their retained earnings and then issue more debt and they do a transformative acquisition. But if that turns out to be a bad capital allocation decision, well, it wouldn't matter if you were correct with the underlying business and the projected cash flows prior to that acquisition. So I really kind of try to shed light on that important thing that capital allocation is key and that you really must take that into account.
Fascinating. So obviously you mentioned the fact that if the company itself morphs into something different, that can be an issue. So do you try to find businesses that are less likely to make M&A and are going to just stick to their core assets? Or how do you start working through the issue of companies with a lot of cash are going to go and try and spend it on something?
Well, I think that's why it's very important to look at the track record of management, because based on what they've done in the past, and not only what they've done, but the commentary of what they wanted to do, and then looking at whether they actually did that or not, is really a good tell as to whether they're good capital allocators or not. So if you find a management team that's done a bunch of acquisitions in the past and they haven't worked well, obviously that's not a good natural candidate. But then also try to understand what their philosophy is, because most managers, even in public companies, and these are very, very smart people, don't understand, for example, or maybe they understand, but they don't fully appreciate the opportunity cost of retaining earnings and reinvesting. And that's whether it's in an acquisition or in an adjacent type of business that they want to go into. And the opportunity cost is just essentially, the fact that you're not using those earnings to give us, the owners, dividends. And with those dividends, we can reinvest them presumably in good opportunities, right? So if you're not giving me the dividends for me to reinvest, you're depriving myself from doing that. And so if you're going to do that, you better have something to show for it, right? And so that's kind of what I try to look at is what their philosophy is, and their commentary and their track record is extremely important.
Ladies and gentlemen, passion is definitely my superpower, and it seems to be the same for Jose Andres Mayora. We're talking to today, talking about Wall Street's blind spots. That's his new book that's out now in the bookstores. We're discussing how he makes his long-term investing decisions from the overall marketplace of Guatemala, which I think was everybody's second guess as to where Jose was coming from today, presuming that you were probably on Wall Street in every possible sense of the term. So you're on Wall Street, but you're obviously working from somewhere entirely different. Do you find that the distance actually helps you to make investment decisions because you're not spending your whole time in the middle of a massive financial center like London or New York or Tokyo or wherever?
Yeah, I do think it helps marginally, just because, as a value investor, you try to be an independent thinker. And to be an independent thinker, you're going to have to stay away from all the noise. So it does help not necessarily to be having a lot of conversations with people who are in the business that can kind of take away that independence from you. But, today it's only a marginal benefit because, the internet and all the media feeds and the notifications you get every day from all the media that you're subscribed to, it's kind of hard to stay away from Wall Street even if you're not on Wall Street. So it definitely does help, but I would say it's a marginal benefit. Like if I think, for example, of like Warren Buffett back in the day, him being in Omaha, well, that would help him a lot because he would be away not just from the real noise, but also from any digital noise. In my case, I still have the digital noise, so unfortunately, I would say so. But yes, it does help marginally.
Yeah, it's interesting, as you say. I mean, given the fact that the sage of Omaha, Nebraska, was just about as far removed from either Wall Street or even West Coast American financial centers like San Francisco as you could possibly imagine. So therefore, Guatemala gives you an elegant triangulation in the world. In terms of when you're investing, I'm just curious, do you do a lot of visits to investors or to the investments you make, or do you do everything remotely without actually encountering the companies?
We pretty much do everything remotely. What I do try to do, and it's almost a prerequisite, we may do an exception, but what we do try to do is always talk to somebody within the company. Hopefully, the CFO or the CEO, but if that's not possible, we try to talk to the investors relations person just to try to get the sense of how they view things from their perspective and see if it kind of coincides with us and try to see if there's a match. So that's super important to us. But today and age, since it's so easy to do that, digitally and virtually, that we don't necessarily need to go to a site. And in fact, we've never done that. Then I also think it has to do with kind of our approach. We really like to invest in things that are super obvious, where you say like, oh my God, the market's crazy here. So when you have that wide margin of safety, kind of the need to go and visit personally is not necessarily there. And time reward is not necessarily the best use of our time.
Fascinating. Yeah, I can see that point quite clearly. So talk to me a little bit more. Let's go back to value investing and, in fact, the main themes in your book. And it's very interesting when you're looking at Wall Street's blind spots. You talk a lot about value investing and particularly market psychology. And I find that very, very interesting within the book, the way that you laid it out. So give us some insights into how value investing really, really helps you better understand the psychology of markets, Jose.
Yeah, absolutely. So when you're a value investor, you're really trying to see the stock as a business, which is what it is, right? A stock is just partial ownership of a business. You're not trying to assess what other people are going to purchase a stock for 3, 2, 5, or 10 years down the line. You're really saying, okay, what's this business really worth now and in the long, based on the expectations of the long term, right? But the market sadly has become a mechanism for short-term thinking and a mechanism where there's a lot of group bias, confirmation bias, and people kind of disassociate the business with the stock price. And that's where things can go kind of crazy. And I always like to say that there's a very simple reason why that happens. It's like somebody who's investing in private markets can be a very rational person. But once you bring them to the sphere of the public markets, it's kind of like a completely different investor because it's kind of human nature. When you have the ability to sell or buy a stock just with a click of a button through any brokerage account or whatever it is, when doubt creeps in, it's really easy for you to kind of lose yourself to temptation and say, no, maybe I made a mistake. If the stock's dropping, that's probably because I missed something, and you sell, or vice versa. The stock's going up and you start feeling the FOMO and you're like, why did I miss? I should have bought here. And if it's gone 20% up, I'm going to invest because it's going to continue flying. And so there's a lot of kind of like short-term psychology and momentum embedded in the market. And the other thing is that the market obviously is mark to market, right? So you can see prices of a stock change daily. And that kind of feels like everyday judgment. When you're in private markets and you're a private equity firm, you buy a company, nobody's telling you on a day-by-day basis whether they think you did a good job or a bad job. With the markets, it's every day. Well, you kind of take it as, maybe I did a good job. It goes down and then you think you kind of did a bad job. So that can really mess up with most people's mind. And the idea of having investing is like, don't worry about that. The market can be crazy, but you're to get your returns from being a long-term investor, seeing how companies create value over time and compound over time. And so that's kind of the idea. And the last thing I would say about that is the kind of self-reinforcing nature of the market. And this goes both in terms of the upside and also in terms of the downside. When the market is going up a lot, for example, you don't only see FOMO, from people, whether it's retail investors or maybe even professional investors. But then you also have a lot of momentum investors who kind of understand the psychology of the market and say, okay, this is going to be subject to more FOMO, so I'm going to buy and ride that kind of FOMO wave and take it all and just essentially ride it. They may actually agree that the market or a particular stock is overvalued, but they still go ahead and invest in it. So that's why when you're a value investor, you kind of just kind of take a step back and say, forget about all that noise and just focus on your independent thinking, your independent analysis, and ignore the market, because the market is very psychological and it's doing things from very different perspective and with a very different criteria than yourself. And so that's kind of what we try to do as a value investor.
Okay, and that's really, really interesting. So I'm quite fascinated because obviously you go through this approach to looking at companies that are going to continue to grow their cash flow long term and are going to essentially be successful. And you mentioned earlier on the fact that the companies, in a way, you said they should be obvious. So I'm just curious, does that lead you to being more likely to invest in any particular kind of company? And what I mean is possibly sectoral, but also possibly companies that are either more mature or indeed less mature. I'm just curious if there's some sort of interesting aside as to what you tend to find are the companies that you want to invest in.
I think the answer to that question is both yes and no. As I said in the beginning, we're agnostic, and really value can be found anywhere. But that being said, there can be sometimes pockets where it's easier to find value. And so, for example, if you compare large capitalization companies with small capitalization companies, there are many players within the market that are not interested in playing in the small capitalization market just because they have so much cash. There may be big funds, institutional investors, that it's not worth for them the time to analyze companies that have maybe $1 billion in market cap, because they would need to buy the entire company for it to move the needle, right? And so the less investors play in the market, the more likely it is that they're going to be undervalued opportunities. So yeah, sometimes there can be this sort of distortions in a more systematic way, but then the reality is that the market can go crazy in any way, shape, or form. So I really do think you can find value in a particular set of circumstances, almost in any sector or in any sort of kind of macroeconomic conditions. So if you think, for example, like 2008, I'm pretty sure there were a ton of undervalued opportunities from large capitalization companies, for example. That might not be the case today, and so we're not necessarily looking at those companies and scrutinizing them on a daily basis because it's less likely. But undervalued opportunities can come and go in different sectors, and it's pretty undiscriminated.
Very interesting. And I mean, also, one of the things I think was fascinating that I was reading in the book is the way you were talking about inverse analysis, or indeed reverse engineering the valuation. Walk us through that, if you will.
Yeah, absolutely. And it kind of touches base on something I kind of mentioned earlier. It's just trying to flip the script of how do you look at companies. And I really can't say how important this is, because if you don't understand this, it's what leads investors to think a great company is necessarily a great investment. And that's not the case. It really depends on what you're paying for the company. So when you're doing reverse engineering, you're basically saying, okay, I'm not trying to project the future and discount the cash flows backwards to get a valuation today. You're doing the inverse, and you're saying, okay, I have a valuation today. The market is telling me what the market thinks it's worth. And then I say, okay, if that's true, what needs to happen in terms of growth, in terms of reinvestment returns, which we can talk a little bit more about that because it's tied to capital allocation decisions. What needs to happen in terms of the longevity of the business? And think about it that way. If you have those kind of hurdles in your mind and say, okay, for this valuation or X valuation to be justified, you need at least 10% growth for 10 years, then you kind of have a North Star and something that guides you to say, okay, your research needs to be focused on determining whether that 10% growth in cash flows can happen. So you start asking yourself, are margins going to expand or contract due to competition? Is the market big enough and is going to grow big enough in order for the company to continue to grow its revenue and its top line? And things of that nature. So when you reverse kind of engineering, you're essentially using kind of like a different tool to guide your research, and it's very helpful. And then the other thing that I'd add is most people, I bet if you ask them, okay, what needs to happen for this valuation to be justified, they don't know. And if you think about it, what that means is that they don't know what expectations are embedded within the valuation that they're buying into. And that can happen again because people do a lot of modeling, a lot of precision, but because they're just trying to think about stocks as a price in a ticker, and they're thinking, okay, I think investors are going to be more optimistic or less optimistic, and use kind of other criteria to judge a company's valuation.
And that, I suppose, brings us to that interesting point. I mean, you've mentioned it, you've hit upon it several times, but capital allocation and the reinvestment rate, because as it says in your book, I mean, that is a key blind spot amongst many investors when we're talking about Wall Street's blind spots.
Absolutely. And maybe it's time to kind of try to take a step back, and you can tell me and interrupt me if you think I'm getting into too much detail, but I think it's so important that it's worth the try and try to explain it at a more granular level. And if you think about just like a bond, because it always helps, at the end of the day, a company is a company that's producing coupons. It's producing the equivalent of an interest, but in the form of profits or cash flow, right? But when we take it to the realm of bonds, it can be a lot simpler to understand. And so if you look at a bond and you say, okay, let's imagine a 10-year bond that pays a 10% coupon, right? So you're trying to determine what's the value for that bond. And imagine it's a $100,000 bond. So that means that every year you're going to get $10,000 in coupon. And then at the end of the 10 years, you're going to get your principal back, the $100,000. So as a valuator, based on conventional financial wisdom, what you should do is you say, okay, I'm projecting those $10,000 in interest coupons for the next 10 years, and then at the end, I get my $100,000. And then I'm going to apply a discount rate to bring the value of those future cash flows into the present. The problem I have with that is that you're discounting each cash flow at a different time period. So the first year's interest coupon, you're just discounting it for 1 year. Then the second coupon, you're discounting it for 2 years. And what happens, in just using those two as an example, is that that rate and the discount return a relationship between the second year cash flow and the present value might be correct. But if you're actually looking at a 10-year time frame, right? So what happens to that second year's cash flow between year 2 and year 10 can really help determine what your actual compounded return is. So yeah, thank you for pulling the chart out, because I think this lays it out more easily. So, and I won't necessarily go into the entire table because I just explained it verbally, but this lays out the case that you would get a $100,000 present value in that example that I used, right? But if you think about it, if you invest $100,000 with a 10% rate compounded annually, by the end of the 10 years, you're not going to get $200,000, which is what your bond is telling you that those are the cash flows that you're going to get, right? But if you compound something that's today $100,000 for 10% to the future, you actually get $260,000. And so you're saying, okay, but my present value analysis told me what's worth $100,000 using the 10% discount rate. Why am I not getting a 10% return if I invest in something that's $100,000? And the reason is, and maybe you can point to the next chart I had given, the reason is essentially you need to assume that every interim cash flow, so like the cash flow in year 2, needs to be reinvested at a 10% rate for the remaining 8 years. And the cash flow from year 3 needs to be reinvested at a 10% rate for the remaining 7-year period, and so on and so forth. If you do that, you get the same roughly $260,000 coupon to a value in the future, 10 years from now, that you would if you had simply invested $100,000 in something that compounded at 10% rate. So what this tells people, just using a bond example, is that your returns, your compounded annual returns, don't just depend on the coupons that you're going to get or the cash flows from a business that you're going to get. It depends on how you reinvest them. And if we go to the next chart, which will be the last, you can see kind of the sensitivity towards returns that the reinvestment rate or the rate of return at which you reinvest interim cash flows is going to give you. So for example, and again, you can tell me if this is not making sense, I can explain it in another way. But let's say that the coupons that you get, you reinvest them at 7.5% instead of a 10% rate. Well, in that case, your compounded annual growth rate falls to 9.2%. If you don't, for an extreme case, if you don't reinvest the interim coupons at all, so it would be the 0% rate, then you would only be getting a 7.2% compounded annual growth rate. So I'd ask people to just kind of like stop and appreciate that for a second. You had a bond that was paying a 10% coupon, and yet your compounded annual return was only 7.2%. There's a wide margin there. And again, the reason is because those cash flows weren't reinvested. And this becomes even more important with companies, because with companies, the possibilities of what you can do with cash flows are much wider. And the potential outcomes of what you can do with interim cash flows or interim profits are much wider. So people can actually, or companies can actually have negative returns on reinvestment capital. And if you do that, then you're not going to get the compounded annual growth rate you wanted or the compounded annual return that you wanted. And so, and on the other extreme, and I'll finish with this, Patrick, is that the beauty of understanding this is that if you find companies that can reinvest their earnings at high rates of return for long periods of time, then you're almost assured to have a success because compounding will be taking place. So if you think as an example, like a Costco, which is a traditional example, maybe, and I don't know the numbers by heart, but maybe 25 years ago, they only had 1,000 stores. But the profits with those from those stores, they reinvested it into new stores, and so on and so forth. And maybe today they have 3,000 stores. So, and each of those stores is producing a very high rate of return. And so reinvesting within the business has helped the business grow and their cash flows grow. So maybe 25 years ago, their cash flows were $2 billion, and now they're $15 billion or whatever the amount is. And that's because that reinvestment rate has been there. You can find examples, but I don't want to extend myself, of other businesses that do the opposite. And they've been businesses that have been in place for 20 years, but because they're not compounding, their stock price is precisely the same because their cash flows haven't grown. They've actually not had successful reinvestment returns.
Yes, that's interesting. I mean, the whole compounding issue of making sure that you've got a business that's essentially got a scalable model, because otherwise it's going to end up de facto stagnant in terms of profit. So, I mean, I'm curious about a lot of things. I'm fizzing over here, but I'm going to give you a rest for a couple of seconds, Josem, because I want you to be able to regain your calm and drink a little water, because we're going to go to our video of the week, which is our short video we've chosen this week. And we're going, well, somewhere completely different. The return of La Chung. Maggie Chung, you may remember her as the fabulous star of movies such as In the Mood for Love, a particular PLY favorite of the Hong Kong cinema. Her understated debut on the Xiaohongshu social media website drew over 1 million followers in 10 days. Proves that authenticity still reigns. Let's watch the video. Meanwhile, in Big World, Hong Kong actress Maggie Chung is famous for many magnificent performances, such as the fabulous Wong Kar-wai classic In the Mood for Love from 2000 AD, but she's mostly been keeping a low profile in recent years. However, she recently launched a social media account on Chinese platform Xinghongshu, Red Note, with an understated video. With a 70% female demographic amongst the users and 70% of users born after 1990, it might not seem the obvious fertile territory for La Chung. However, clearly, La Chung hit the spot, amassing 1.01 million followers within 10 days of posting her debut video on August the 8th this year. For more in Big World, like or follow. 1.01 million followers within 10 days. Now, there's a good example of compounding, admittedly, in social media terms. I'm sure the money follows that without any difficulty whatsoever. Our finance book of the week this week is by Lars Fede, Business Cycles, History, Theory and Investment Reality, describing the global history of investment, economic fluctuations and business cycle theory over more than 300 years. Our next book of the week will be unveiled in our free Exchange Invest weekend, which is our macro read. You can unveil that on Saturday, when we're going to have a particularly automotive theme, ladies and gentlemen, because you may or may not be able to recognize from my tie today, but we're all talking about cars this week because I am on my way to Malta this week to be the lead commentator once again for the Malta Classic, the Mdina Grand Prix, Valletta, Malta's most prestigious motorsporting event. You can catch you on the mic Saturday and Sunday beside the historic ramparts of Mdina if you're in and around Malta. And don't forget, if you want to keep up track with what's going on in the world of exchanges, Exchange Invest via exchangeinvest.com, only $499 to join the exchange of information. Read there everything you need to know about the bourse business. Our guest today is Jose Andres Mayoris. We're talking about his fascinating book altogether, Wall Street's Blind Spots. And I mean, I'm very interested because you've given us this great model of compounding and how important it is to keep reinvesting, keep working in. But of course, one of the problems when you're analyzing companies is the fact that accounts aren't always quite what they seem to be, Jose, are they?
No, absolutely not. And that's why it's so important to not underestimate qualitative research, because you can look at the numbers and the numbers seem to tell a story, but if they're not in parallel with the actual qualitative story, like what's going on behind the scenes, what decisions are driving such success, how sustainable it is in the future, what they've done in the past, what risks are present, and so on and so forth, then no matter how good you are at looking at the financials and whether compounding has been present or not, you simply are not assured of the outcome in the future, right? And that's actually one of the biggest investing mistakes that I see people make all the time, is just extrapolating the past to the future. And you can do that specifically because of how the financials have done in the past or how the stock price has done in the past. But the qualitative research aspect of it is super important for that.
Yeah, I mean, it's quite fascinating in order to manage to do that. And one of the things that also therefore was interesting, obviously, accounting profits don't always equal cash, as you've been pointing out in the book. Cash at the same time is king. How do you manage to look to a balance sheet and actually discern if the cash is really there?
Well, the first thing I always do, and in fact this is how we kind of always filter which opportunities may be plausible and which ones are not even close, is to always look at the cash flow statement. Because the cash flow statement, on the one hand, will tell you what things were non-cash, and then based on what those things are, you can start to think of whether those non-cash expenses are actually recurring, and if they do actually represent a cash flow impact in the future, and if they don't, you can pretty much ignore them. But then you can also see kind of the fluctuations in working capital and whether that will, because it does happen on some occasions, will impact your cash flow on a recurring basis, even though it's supposed to be temporary. But then also, most importantly, you see what the company has done with its cash flows. You see whether they've invested in CapEx, whether they've done acquisitions, whether they've repurchased shares, whether they've paid dividend. And so going back to what we were talking about before on capital allocation, the cash flow statement is kind of like the first place where you can look at and see what the track record of the management team and the company is in terms of what they do with their cash flows. But then the other thing I would say in reference to your comment of cash is king is that people oftentimes compare price to earnings ratios. It's like obviously the most common metric used out there, but not all price to earnings ratios are created equal because not all earnings are a proxy for cash flow. Sometimes there are, but sometimes they aren't. And so you have to be very diligent and try to, instead of looking at earnings, try to see, okay, what's the price to recurring cash flow ratio? And then maybe it can be even more helpful. But then in addition to that, the price to earnings ratio has the disadvantage that you're looking at it as from a static perspective. You're not looking at cash flow's evolution over time. So you can have a company that has a price to earnings ratio of 7, for example, that looks pretty cheap. But if you look at the history of the success of reinvesting cash flows and whether that has led to an increase in cash flow from operations over time, if it hasn't happened, meaning the cash flow from operation hasn't grown over time, then that price to earnings ratio is actually pretty high in my opinion, because it means that management has retained cash flows, has reinvested in the business, and yet the cash flows from operation today are the same that they were, or even less than they were 5 or 7 years ago. And so that means that the reinvestment returns are low or possibly even negative, and so there's no compounding there. So that's kind of what I mean with cash flows. You need to look at cash, not earnings, and then even when you adjust for those discrepancies, you have to understand that when you're looking at static ratios, you're not necessarily looking at the entire picture.
That's fascinating. And yes, the static ratio issue, I think a lot of people think that suddenly there's some magic number that's going to give them everything that will allow them to invest in companies and give them perfect timing, which is quite important. I'm just curious, actually, a side question. I'm going to come to back to your book in a second. Do you and have you ever invested in any exchange businesses? Just curious, as obviously we publish Exchange Invest, or have you run your slide rule across them and not found them sufficiently interesting?
I haven't ever invested in an exchange business, but I do have to say I love their underlying business. So like if you look at ICE, which is the ticker for the company that owns the New York Stock Exchange, for example, it's been a great business, it's been a huge compounder and a huge success. And there's many reasons for that, and it has to do with the higher investment rate and the moat that they have and the barriers that they have. But the only reason I haven't invested, even though I love the underlying businesses, is because I've never found them at a price where I think the margin of safety is wide. And that comes back to the point of, you need to understand what expectations are embedded in a given valuation. Because sooner or later, if you bought into expectations that were too high and that didn't offer a margin of safety, the market's going to correct and you're either going to get losses or going to remain stagnant for about 10 years. So like, for example, if you, or even more, if you look at Microsoft in the year 2000, it was a great company and a great business, but the stock price fell significantly in the dot-com crash, but then it stayed below its peak for about like 15 or 20 years until, right now it's also flying, but nobody would have waited 15 or 20 years. And it wasn't because Microsoft stopped growing or stopped being a great business. It was just because the price was so high that when the market started doubting about the expectations that were embedded in that valuation, they said, no, we kind of have to re-rate this. So that's the only reason why I haven't invested in exchange businesses. But I do think they're great. They're one of the companies that have the strongest moats. They're kind of like have quasi-monopoly positions. Their network effects are great. So I'd love to get the opportunity when they're undervalued, if that ever happens.
Yeah, I agree with you there, because I think one of the big problems with particularly Jeff Sprecker's Intercontinental Exchanges, he's such a brilliant entrepreneur, so many people are watching, that anytime the stock dips to any degree whatsoever, you suddenly find a load of people who are very, very eager to perceive that that's value and jump back in before it necessarily becomes super exciting for a value investor such as yourself.
Absolutely. I couldn't agree more.
So to tell us, I mean, as we're getting sort of 3/4 of the way through the show, we're into the home stretch, as it were. You had some great advice within the book about things to avoid and tips and pitfalls to look out for. Can you run us through a few of those, please, Jose?
Yeah, absolutely. And I'll kind of go on them briefly, and then you tell me which ones you think might be more interesting for the audience. But the first one, and we kind of already talked about this at least in a very indirect way, is that great companies are not always a great investment. That's the first thing, because I can't tell you how many times people come and pitch an idea to me and they start telling me about the merits of the business, and I'm looking at them like, look, I don't disagree, but you haven't even mentioned what price it is. So that's the first thing you have to look at. Okay, it's a great business, but if it's not at the right price, then it might not be a good investment, right? So that's, I think, the first thing. And conversely, you can have, although I personally don't like to play here because it's a lot more work, but you can have the situations where you can have a bad business, but it's so cheap that it's actually a worthwhile investment, right? So just keep that in mind. It's super important. The other thing is that, we also talked about this again, is be very careful of extrapolating the path to the future. And this is both not just from a stock performance standpoint, but also from business performance standpoint. I mean, I can't tell you how many examples I've seen of companies that for 5 or 10 years have been doing great, and then out of the blue, some new risks emerge, and then boom, the story completely changes. It was a growth company, and then it suddenly is a more mature, stable company. And if you were paying price to earnings ratios of 40 times, when that shift happens, you're toast. So you have to be very careful, and you have to really understand the arguments as to why the company is going to continue growing and compounding. What are the barriers to entry for competitors? What is the moat? And all of those things that are absolutely necessary to find peace in investing, at least when you're investing in a concentrated manner. Then the other we also talked about have to focus on cash, not profits. Profits are made to inform investors, and accounting, the way it works is they want to release anything that's material, but sometimes that leads to profits not necessarily being a proxy for what the cash flows are going to look like into the future. So it's very important to understand that. And again, I would advise people to always look at the cash flow from operations. It's the most important financial statement out there. I know people like to think it's a balance sheet, and obviously the balance sheet's important, the income statement is important, but the cash flow statement is the key to understanding what something can be worth. And then you can go to the other statements. And then one thing that I think is very important, and there's several, but I'll leave. I'll say this last, is you have to understand that growth can't continue forever. I mean, markets so often, and I think it's the case today, price things like growth can continue indefinitely. And I think people need to understand that when a company or a sector is doing very, very well, that invites so much competition that unless there's a big reason why a company is protected from all those incumbents, I think people need to be very, very cautious about justifying high prices just because there's growth. Because eventually all companies mature, eventually all companies' margins either stay flat or contract. So very important to always keep that in mind and not kind of let yourself dive deep into the hype of things. Like right now, obviously, artificial intelligence is super hot, and obviously everybody agrees it's going to change our world. It's already changed our world, but that doesn't mean that the underlying companies are all going to do extremely well from a profitability standpoint. There's a lot of capex that is going into them, and there's a lot of competitions from all the big players. And so just keep that in mind. Growth can't happen indefinitely.
No, that's a great point about growth can't happen indefinitely. And also the fact, as you say, the moat is very important. I mean, you talked about that with Intercontinental Exchange, and I can think of, well, at least one or two businesses I've even been on the board of where they had fabulous cash flow altogether, but the difficulty was they had next to no moat. And hey, presto, guess what? If you don't manage to diversify or build that moat, you suddenly find that competitors can manage to come in and they push prices down and they kill your margins. And that's something we can see all too easily across a plethora of businesses. And I mean, I'm interested actually in your take, because one thing I notice is that companies seem to be lasting less and less years. I mean, the average, I think, what is it? The S&P 500, the average life cycle of a company in the S&P 500 is now like 15 to 17 years. And I don't mean how long they're in the S&P 500. I mean, how long the company actually lives for from startup to death, which is obviously quite incredible. How does that impact a value investor such as you?
Well, I think, and the only way it really impacts is in understanding and having perspective. And it's kind of invites you, it's the type of statistic that invites you to be very, very cautious, and the reason why you always want to look at a margin of safety. But in reality, it doesn't affect us much because we're not kind of macro-oriented or doing top-bottom analysis. We're really just focused on the individual companies that we find extremely interesting. And so as long as it makes sense for that particular company, whether others are going to kind of die along the way more quickly, well, that's a separate problem for somebody else, not necessarily for us. But again, it does invite us to be very cautious. And I think within the bloodstream of every value investor, the word caution is kind of written all over the place. And that's why we always try to look for a wide margin of safety, because it's super important. And especially now in an ever-evolving world, the pace of technology improvements today, I would argue, are significantly higher than the pace of technological involvement movements, 70 years ago. And so you have to be very important and kind of say, hey, do I really think I understand a particular sector or a particular company well enough and all its uncertainties to expect the business to be here 20 years from now? I mean, if we just think of the classic example of Yahoo, I think, if I'm not mistaken, Yahoo had the largest market cap of any company in the S&P 500 in the year 2000. And Yahoo doesn't exist today. I mean, there's some remains for their website and some part of our media business, but not as a company, right? So it does invite you to be very cautious, and I do think it's very important to take the pace at which things change to be taken into account as you look into wide margin of safety, especially for technology companies. Like that would be different if you're looking at an insurance company or maybe even a bank. But if you're looking at things that are involved directly or indirectly in the technology sides of things, it's very important to be very clear.
Wow. Well, you know what? On that note, I think you've given us an incredible number of Wall Street blind spots and some great insights altogether, Jose, about how we can manage to do better with value investing right around the world, wherever we're based, in Guatemala City or elsewhere, even Warsaw, Poland, where I am today. So let me take you from Wall Street's blind spots to that last question we ask all our guests. Jose Andres Mayora, where do you think the capital market revolution goes next?
Well, I think you're actually going to like this one because, it's very convincing in my book. I think we're going to move to a money without borders. So if you think of like the exchanges in the foreign exchange markets, not that they're going to disappear, they're going to be there, but their importance is going to be diminished by things, in particular, the company called Wise, which is the case study I talked about in the last chapter of the book, how they managed to create their own infrastructure to move money across borders and cross currency in a seamless way without having an exchange in between. And obviously, I won't go into the details of how that happened, but I think that's the revolution that a lot of people are asleep about yet, but in the next 5, 10, and 15 years is going to become increasingly evident.
And on that note, Jose Andres Mayora, I want to say thank you very, very much for being our first guest to join us from Guatemala City in Guatemala. Incredible nation, actually, 18.4 million people, so only a little bit shy of, say, for example, Romania in terms of total population, it's about 21 million. Thank you very, very much for being part of this show. This has been a opportunity to discuss the fabulous blind spots of Wall Street. Do go out, rush out and get a copy of Jose Andres's book. Thank you very, very much to everybody who's liked this show. Do please give us a little bit of love because that helps the AI bots understand just what value we've managed to bring to the world today on value investing, no less. My name is Patrick L. Young. I want to say a huge thank you to our production team today, Desiree Herminia and Janella. You've been super smooth behind the scenes. We're going to be returning next week. Should be same time, same place, unless, of course, I happen to lose my voice while commentating on the car racing at the weekend. See me in the meantime at the Mdina Grand Prix. And don't forget, you can catch up with everything in Exchange Invest Daily. And of course, if you're looking for your exchange or marketplace to be built, then get in touch. That's our business. Ladies and gentlemen, I want to say thank you very much for joining us for IPO-VID number 189. My name is Patrick L. Young, and I wish you a great week in life and markets.